Have a look at Tata Steel, for example. Another story, completely different story, very cyclic here. Ups, down, ups, down, up, down, up, down. Hi everyone. If you have never invested in stock market, by the end of this video, you will be able to invest 1 lakh rupees very safely. 2 quick points before I start the video. Number 1, I will only speak in 6 simple steps. And point number 2 is, please do not skip this video, because if you skip the video, you will understand half of it and you will make mistakes while doing investments. So request you to please watch it till the end. Let's start. Step number 1 is to understand the bigger picture. For that, let us understand the rule of 70 or rule of inflation. It simply says that if you divide number 70 by current inflation rate, you are going to get a value, and that value tells you the number of years by which your current value of the money will depreciate by 50%. For an example, in 2022, India's inflation rate is roughly 7%. If I divide 70 by 7, we get 10 years, and that means by the end of 10th year, your current value of the money will go down by 50%. So for example, if you have right now 50 lakh rupees, then by the end of 10th year, that 50 lakh will become 25 lakh rupees in terms of the purchasing power. Therefore, we need to make sure we protect our money and do not let the inflation eat up all our hard-earned money. And the only way to do is to invest this money very safely. Now you will say to me, Rahul, that's not a problem. I will go and invest this money in fixed deposit. That's fine. But let me tell you that fixed deposit interest rate that you are going to earn will be, let's say, 6% right now, and you will have to pay tax on it if it is above your tax band. And more importantly, in many years, FD rates are not able to beat the inflation rate. So therefore, we need to make sure we are investing this money in stock market. Let's move to step number 2, which is understanding the risk. This is very, very, very important. So please pay attention. Let me start asking by a question to you. What do you want this 1 lakh rupee to become? Please pause this video and drop it in the comments. Now, if you have written that, Rahul, I would like this 1 lakh rupee to become 2 lakh rupees, and that too overnight, great. I like that thinking, but please understand, if you want your 1 lakh rupee to become 2 lakh rupees, that too overnight, whatever you invest in, that 1 lakh rupee also can go to 0 rupees. And that's where the concept of risk comes into picture. And as a beginner, if you've never invested in stocks, we are going to now talk about the risk that you must take or the risk that you must avoid. I can divide the entire stock market into 3 risk profiles. Number 1 is low, medium, and high. So if you look at company number 1 to 100, they all can be categorized into low risk area. Why? Because these are large cap stocks and they are very stable companies, they are very matured companies, they have a steady stream of revenues and profits. Therefore, the chances of they giving negative returns is relatively low. So this is the lowest risk categories. Examples: Reliance, TCS, Infosys, and so on. The second category is the companies which fall under rank from 100 to 250. These are called medium cap stock companies. For example, Zomato, Relaxo, etc. And these companies have the potential to become the large cap stock in the coming years. They are already earning good amount of profit and revenues. The third category is the highest category in terms of risk, and they are called small cap companies from 250 onwards. These companies could be, for example, EKI, JP Paper Limited, Bajaj Consumer Care. These companies are relatively small and they are very volatile in nature. They can give you very high returns, but at the same time, they can also give you higher losses. So that is the 3 categories. Now, as a beginner, if we want to invest 1 lakh rupees, my recommendation is to implement 80-20 rule here. 80% of 1 lakh rupees, we are going to invest in the lowest category of the risk, which is in large cap stocks, and 20% of 1 lakh rupees, we are going to invest in the small cap stocks, which is the highest risk, so that we are experiencing both ends of the spectrum, highest risk as well as lowest risk. So far, if you're liking this video, please press the like button. It will mean a lot to me. Moving on to our step number 3, which is understanding the investment vehicle. Technically, it is also called understanding the asset classes, but let's keep it simple. Now, there are 3 ways in which we can invest our 1 lakh rupees, right? Number 1 is buying the direct stocks. Number 2 is mutual funds, and number 3 is index funds. So the first investment vehicle, which is directly going and investing in individual stocks, it's a big no for any beginners. And the reason is that you might have heard this saying as well. 90% of the investors lose 90% of their money in the first 90 days. And the key reason is that they go and buy stocks because A, their friend might have recommended it, B, that they know that the prices have gone up recently, so let me go and buy it. There may be a number of reasons, but please make sure that you're not investing your first investment money into any direct individual stocks. The reality of individual stocks is very different because every stock behaves very differently. So if we have a look at, for example, the top company on NSE, which is Reliance, you will see here that if you invested some money in Reliance in 2008, the price was 773. And if you come to 2017 or 17 here, 17, you will see that the price is 528. So in 10 years time, you have lost money. While if you invested in 2017, which is at 528, and in 2022, you would have almost 5.5 times made that money, which is 2580 right now. So let us look at Asian Paint, for example, another example for you. If you say a very different story here, it is continuously growing, a evergreen stock with some ups and downs in between. Have a look at Tata Steel, for example, another story, completely different story, very cyclic here, ups, down, up, down, up, down, right? So my point is that each stock will behave very differently. And as a beginner, you will need to understand fundamentals of a company. You will need to understand technical analysis of a company, when to enter into a stock, when to leave a stock, how much to invest, what is the PE ratio, and there are so many things. So as a beginner, I recommend you to not invest any money directly into the stocks. And that brings us to our investment vehicle number 2, which is mutual funds. And mutual funds are a great way to invest money where we need an expert to be able to actively go and pick the stocks that are really good for returns, right? And that is where I would suggest that we are investing 20,000 rupees via mutual fund route into the small cap category. And now why small cap category? Because as I said earlier, small cap category is very volatile. It is very risky. It needs a lot of expertise in terms of when to pick the right stock. And that is why we will literally outsource this investment activity as a beginner to a mutual fund, a good mutual fund who will go ahead and pick the right stocks for us and in turn will give us good returns. The third investment vehicle is index funds. Index funds are a type of mutual fund, but they are cheaper to buy and they need little expertise, literally very less expertise. For example, a good example is Nifty 50. By investing in Nifty 50 index, we are able to invest in top 50 companies, which are more stable, less risk. So overall, our portfolio of 1 lakh rupees will get divided 20% in mutual fund route and 80% by index funds. Step number 4 is to select the right mutual fund for small cap category where we are going to put this 20,000 rupees. So I recently created a video on my YouTube channel. I'll link it somewhere here. And I analyzed 60 plus mutual funds in small cap category and I selected top 5 mutual funds. You must go ahead and watch that video later on. But in summary, these 5 mutual funds were Axis Small Cap Fund, Nippon India Small Cap Fund, SBI Small Cap Fund, Kotak Small Cap Fund, and Canara Robeco Small Cap Fund. All these 5 funds are good. You can select any one of them. But my preferred fund out of these 5 were Axis Small Cap Fund. 3 primary reasons: lower expense ratio, secondly, higher alpha, and finally, Axis Small Cap Fund invest 80% of their money in the equity market and 20% in debt. It's a really good balance. That is why I personally last month invested in Axis Small Cap Fund as well. And you can see that in just 1 month, it has given me 8% return. I know the market is up, but if I keep going this rate, that by the end of this year, I would double my money in Axis Small Cap Fund. Moving on to step number 5, which is to select the right index fund. So remember, we have talked about putting 80,000 rupees in the index fund. Out of that 80,000, my recommendation, my strategy for a beginner is please invest 60,000 rupees in the Nifty 50 index, right? Nifty 50 index is one of the best index out there for Indian markets because it basically captures 60% of the stock market. It invests in the top 50 companies, right? On NSE. So likes of Reliance, TCS, Wipro, all the blue chip companies, right? And in the past, it has given really good returns. It is the lowest risk in terms of the overall stock market. So my recommendation recommendation is to go ahead with Nifty 50 index. I created a separate video on this entire topic where I have gone through a step-by-step process of selecting index funds, and my favorite fund there was UTI index fund. I'm personally invested in UTI index fund. You can see that in the last month only I invested some money in UTI index fund again, as I keep doing that, and it has already moved positively, but over a longer period of time it is going to give good returns, right? So 60,000 rupees in the Nifty 50 index of your choice. My personal investment is in UTI index fund. Step number 6 is to then think about investing the remaining 20,000 out of 80,000 into US index funds, which is my main point of diversification. Diversification is absolutely important. We are investing 80% of our 1 lakh rupees in Indian stock market while 20% in US stock market, and there are a couple of reasons for it. Number one, right now when I'm recording this video, Nasdaq 100 has corrected almost by 22%. That is a great time, I believe, to start investing and thinking about US market. Number two is that in Nasdaq 100 index, the number of companies that are listed there are all blue chip, great companies such as Google, Amazon, and many more, right? And because it has corrected a lot, there are chances in the next 3 to 4 years, it is going to rebound back and their returns are going to be really good. And lastly, if you get exposed to US stocks, your investment journey will start with a right level of diversification. So please consider investing the remaining 20,000 in Nasdaq 100 index. I've created a separate video where I've explained the differences between Indian ETF investing in US stocks as well as US index ETFs that are investing in US stocks. There are two funds here very quickly. If you're going with a US index fund, it is Invesco QQQ Trust Series 1, one of the best in the world. Again, it's all captured in that video. Second one, if you're looking to invest from India's perspective, you can consider investing in Motilal Oswal 100 ETF, not the fund of fund. Motilal Oswal 100 ETF. It's a good fund relatively, so you can consider investing in that as well. Again, I cannot give you investment advice, but I've created a separate video where I've compared both these funds and I've shared the pros and cons of both of these, right? To summarize, the 1 lakh rupees we are going to invest 20,000 rupees in the small cap mutual fund categories. Remaining 60,000 we are going to invest in Nifty 50 index fund, and last 20,000 rupees we are going to invest in Nasdaq 100 index fund based in US. Please also make sure that when you're investing this 1 lakh rupees, have a horizon of at least 5 to 10 years, because in longer term you are going to get more returns, better returns, and less volatility. And I'm hoping that by the end of 5 to 10 years of period, you are likely to get up to 25% return year on year, which is a good return considering you are a beginner starting your investment journey. If you like this video, please give this video a thumbs up. Drop any questions you may have in the comments. I will try my best to answer each one of them, and please subscribe to this YouTube channel because I talk about career, money, and many other interesting topics that might add value to you.